Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes every Friday to take a deeper dive into the markets and economic data to see if we can find anything that makes sense. And we probably won't, but we'll still try. So I want to talk to you tonight about how commercial industrial lending is, it started to contract, not deeply, but still it started to. And real estate lending is very close to contraction. We've looked at the data, we've chatted about this a little bit, but it's a much deeper issue than I think anyone really understands. And so I thought tonight we'll explore that a little bit deeper. So I'm going to talk about it, then I'm going to show you the data, and we're going to kind of look at some of the Fed, some charts, and we'll kind of see if we can make sense of it. So let's go back to the dot-com bubble. I think we all remember that, or at least those of you who are old enough that are watching, hopefully you all remember that. But anyways, it was a time of great excess in tech stocks, and they blew up, and we had a huge bear market and recession where tech stocks dropped 80%. I know people can't even imagine to say Apple stock could even drop a couple percent, let alone big tech stocks dropping 80%. But what triggered that? Well, I went back and looked at the commercial industrial lending data, and it contracted right around the time the bubble blew. And I started thinking about why that would occur. Well, so in a debt-based economy, you need a constant expansion of debt to support economic growth and asset prices. And depending on where that growth is, so if it's in a narrow focus of the economy, say tech stocks, well, then you would expect to see money flowing there. So what happened is, in order to keep these unprofitable tech companies, expanding where their stock prices going up and up and up, they needed cheap and easy money. Now, the simple solution is, well, the Fed tightened. You always say it's because the Fed. Yes, but it's the consequences of the Fed tightening that we have to look for in the data. So what happened is commercial and industrial lending slowed down ahead of the bubble popping and eventually contracted. And what that told us, or what that tells us now, is there wasn't enough money to keep the bubble going. See, in debt-based systems, you need not just a constant expansion, you need an exponential expansion of debt. It can't just grow, 5% a year. It needs to grow faster every year, because not only does it have to support new growth, but it has to prop up whatever the existing asset prices are. So we had the dot-com bubble burst, big recession, but the real estate data was still running like 8% year over year. So even though a certain segment of the economy went kaboom, and yes, it hurt and affected a lot of people, the other side of the economy kept running. And so investors said, hey, I learned my lesson, don't buy things that are high and overvalued, namely stocks. So what did they do? They started buying real estate that was high and overvalued. Didn't learn, they just switched directions. So what happened to the underlying data in the real estate, in the mortgage bubble? Well, if we look at real estate lending, it contracted and popped the bubble on the exact week the bear market started. Exact week. Now, why would that make sense? Why did the real estate bubble burst? Because it needed a constant expansion of debt. And not just a little bit, it needed, your direction, it needed a lot of debt, an exponential amount. And it slowed down and contracted, and the bubble had to burst. But if we look at the commercial and industrial lending data back in 2008, it was still growing fairly well. In fact, it didn't contract until March of 2009, which was the exact bottom of the stock market. So while the real estate bubble did have a massive effect, it didn't affect the entire economy. But today, now that I am taking that view on what this data means, commercial industrial lending on a 3-month basis has contracted. The 6 month is bobbling like 0.2% plus or minus, so it's effectively zero. And the year over year rate of change is falling. And the real estate data, as we'll look at, is positive, but not much. This will be the first recession that we've ever had where both sides of the economy are going to contract simultaneously. So people who have bought real estate saying, hey, I'm going to buy real estate instead of stocks because I'm not making that mistake, they're in trouble. Or people that are counting on their equity to get them through retirement, not going to work. And people have bought stocks saying, yeah, I learned my lesson from real estate. Stocks are where it's at. Well, there's no safety net there either, because you say, well, wait a minute, what does commercial industrial lending have to do with stocks? Aha, good question. Good question. I'm glad you asked. The answer is simple. Who has been the largest buyer of stocks? Well, the last 10 years, who? Not you, not me. Corporations. They've been buying their shares back. And how have they been doing it? Now, not all companies are like, say, Apple, that have massive amounts of free cash. Most companies don't. They've been borrowing the money every year after year to buy their stock back. And guess what? What we can see in the commercial data, they're not borrowing. They're flat, starting to contract. Now, why does the contraction actually matter? Because that's where money gets destroyed, and that's kind of the end game. Now, the dot-com bubble, we didn't have to get a contraction in commercial lending for the dot-com bubble to blow because it needed so much money. It was an addict. The tech stocks were addicted to cheap money. They needed a lot of it. So when it started to pull back, that was the end of it. The mortgage bubble needed money, and it took a contraction for it to blow on the exact month. But now we've got both of them at the same spot. I'll show you. The content of this video is provided as educational information only and not intended to provide investment or other advice. It shows not to be construed as recognition or solicitation by selling security, financial instrument, or participating in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in this video that one do not reflect the view of Atlas Financial Advisory Inc. or Steven Van Metre Financial. So let's go and look at the money supply first. It's starting to slow down on the 3-month rate of change. I'm kind of expecting this because, again, you have the two biggest money generators are slowing down and almost contracting. Now, it doesn't mean that if they both contract that the money supply will turn negative. It does not imply that. It does mean it should slow down. So I've added up here not QE because Fed has not given us their official name of what they want to call it. We'll get that probably on Wednesday at the press release because that's when the Fed has their press release from their committee meeting where we will expect them to lower interest rates. So the 6-month rate of change, the 12-month is flat. The 6-month rate of change is still rising, but the 3-month rate of change looks like it's slowing down. Rolling over, too early to call, but definitely slowing down. So let's go to real estate loans. So the growth rate was up slightly, 3.44. We're talking tenths of a percent difference here. And same with the 6-month rate of change. It ticked up a couple. I think it was around 1.4 to 1.6. Not a big change. And the 3-month rate of change ticked up a couple tenths of a percent. Again, not a lot of change here. But what's key is, again, downward move in interest rates, no significant change in real estate lending. Downward trend in interest rates, significant change in real estate lending. Under this box, downward trend in interest rates, significant change in real estate lending. So what it's still telling us is even though the market believes interest rates need to go higher, it doesn't. These low interest rates are not spurring reflation. So if you're worried about interest rates going higher, you're not seeing it here. Let's go look at the commercial industrial. Oh, you know what? Let's pause here for a moment. And, I meant to have the Fed H.8 data loaded up, and I accidentally closed it. Let me reload this. So while we're on the subject of, let's do the commercial industrial lending, and then we'll come back to that. So commercial industrial lending, flat growth rate from 4.9. It's really not growing at all on a 12-month basis. Actually, I think it may be down slightly, but it is flat now that I recall. The 6-month rate of change ticked up from slightly negative to slightly positive, but it's almost a rounding error at 0. And the 3-month rate of change went lower. So it says commercial industrial lending is not growing. It's starting to chew up money, which is not good in a debt-based economy. And so let's go look at the H.8 data. And let me just make sure you can see that. Okay, so let's go down. And we can see Treasury and agency securities, they dropped, $7 billion, no, it's about $6 billion actually. And you go, oh no, but that's a problem. Well, the good thing is mortgage-backed securities increased by $2 billion, but treasuries decreased by $7 billion. So before you panic, let's take a look and see which one of these two have a bigger impact on long-term yields. Now, we've looked at this chart here, which is pulling the mortgage-backed data, and I've shown you can see when the banks on a year-over-year rate increase their portfolio of mortgage-backed securities, long-term interest rates, shown inverted here, fall. And when banks reduce their mortgage-backed securities holding, long-term interest rates rise. So what's happening here? Banks are still picking up $20 billion a month of mortgage-backed securities from the Fed, and we have a down move in yields. An up move in yields, shown inverted. Is that a problem? Well, there has been cases where banks have increased their holdings, yields have risen, and then they turn around and fall. Here you can see it again. Banks are still adding, yields are rising, and then all of a sudden they turn around and go, oh, whoops. So this move is not validated here. The data does not suggest at all that this recent pullback is anything more than a short-term move. Now, what if we compare it to the Treasury and agency Treasury securities and strip out the mortgage back? Again, this one was strictly mortgages. This was strictly treasuries. You don't see the nice correlation here because you see interest rates falling and the banks are reducing their treasury holdings. It doesn't make sense. So this is not showing us anything to be concerned that this line right here has dropped some. In reality, when did the Fed start their quantitative easing program? Well, they started it in October. And guess what? Who do they sell? Who does the Fed buy from? They buy from commercial banks. They do not buy from you and I. They buy from commercial banks. So this is not impacting long-term interest rates. The key is right here, this is helping, but the market is, again, fighting against it. And of course, the market can do that for a while until it's wrong. All right, let's continue on. Looking at consumers, credit card growth rates flat at 3.6%. So no sign of reflation here. So far, we've got no reflation, definitely no reflation because we're in contraction, no reflation. Nothing, no indication. And then looking at China, why are they injecting a whole lot of currency into their economy? Because the year-over-year rate of change of outstanding loans of China's international investment position, well, it's at zero. Perhaps this is why China's injecting yuan into their economy. Again, you get the same story with these issues in debt-based economies. Let me close that out of the way. Bring Excel back up so we can see. All right, let's go on and take a look at the Nasdaq Mcclung Summation Index, and we can see I believe this is a close. Nope, closed yesterday. It's trying to fight back to the zero bound. It's very tight in here, even though the market's reaching back toward new highs. Liquidity is not. The market is really just pulling on fumes, and this is part of the reason why we're seeing people short the Treasury market because they borrow Treasuries, sell them. Borrow them from the large banks, sell them, take the money they receive from the sale of those, and they buy stocks with them. So let's take a look on crop condition. And I want to comment on this. I've been watching Twitter, and this is not going to be a blanket statement for all farmers, but farmers that are harvesting their early fields right now, that the early of the late planting, are saying that their yields are 10 to 13% less than last year. That's what they're looking at. When they were asked about their late plantings of the late planting, which they have not harvested yet, they said it's much worse. They don't know how much worse. Their risk right now is high winds and anything that knocks like corn stalks over, snow, hail, or anything like that. The crops are frozen. They're not growing anymore. So when we look at this and we see 90% colder than normal, that's as long as it's just cold, it's not an issue. What's problem is if there's snow in here. Now, we don't see high precipitation. We see below average, but some models are showing there's going to be snow somewhere in here, and that would not be good for farmers. Again, you see the cold is still going to stay in this region. Not so much strong precipitation, but again, they get anything that knocks these plants over, and that is a problem. So we've looked at the H.8. We've looked at why Treasury yields are still likely to go a lot lower. I mean, you've got a lot of other issues here. You've got, you have to keep asking yourself, is the repo problem with the overnight collateralized loans, is that a sign of a healthy monetary system or not? It's not. And what has happened in the past? Interest rates go down. We're at the very late cycle. Interest rates go down because there's no demand. So you start looking at these things and you have to keep asking, is there reflation here? No. There's not a sign of it. Look at the weekly. We could go back and say, well, what about the weekly mortgage data? Was it down 12%, I want to say, last week? That's not a sign of reflation. Housing prices rolled over. Do you know how often that you see new home prices fall in an economic expansion? Never. When new home prices start to fall, that's a big indicator. So you have new home price sales fell. New homes sold fell, or the amount sold. Existing home sales fell. No reflation. So what's going on in the bond market? I think it's a lot of speculators that are trying to short this to drive the stock market to new all-time highs. Now I have a preview of Monday's data because the guy that posts on hedge fund positioning, on Fridays he posts one or two charts sometimes. He posted the volatility positioning near record short. And when you have near record short volatility and you have at the moment, and I forgot to show this to you, over the last 90 days, stocks and treasury yields are back connected. That's music to your ears because right now it tells us the bond market's just reacting to the stock market. The stock market's going to have a big sell-off. Guess where interest rates are going? Down. Let's continue with this view. And all right, we looked at that. Okay, so coming into next week, we've got non-farm payrolls coming. And this week I'm going to show you why that matters. Durable goods, new orders. Now, why do new orders matter? Well, if you're a business, it matters a lot. So let's say you're a manufacturer, right? You manufacture as orders come in. Maybe you manufacture a little ahead of that, but the idea is you're manufacturing as orders come in. So if the number of orders this month is less than it was a year ago this month, is that good or bad? That's bad. And if the next month it continues to be less, that's bad. And the next month, even lower than the year before, that's bad. And what happens when you have a business where your new orders are falling? What is one of the first things that you think about doing? Well, first you tighten your belt, right? All right, we'll do a little trimming, maybe cut some overtime, and maybe this is temporary. What happens when it persists? Pink slips. So here what you see is unemployment level versus in manufacturers' new orders of durable goods inverted. So red is inverted. So what you can see is new orders are starting to flatline. They're in blue. New orders starting to rise. They're inverted. They're starting to fall. Jeez. Eventually I'll get it right. And so what does that mean for unemployment? Well, you can see when durable goods new orders start to fall or inverted rise, here you see them. What happens to the unemployment rate? It increases because people get laid off. Now let's look at new orders proper showing on a year-over-year rate of change versus the non-farm payroll on a year-over-year rate of change. And here you can see that durable goods new orders are falling. Out of 5 months, they're down 3 out of the last 5 months, and they're headed lower. What does that tell you for the non-farm payroll that's coming out next Friday? What are the odds? Look here and here. When durable goods start to contract, do you think you get an increase in payrolls? No. And what does that mean for interest rates? Well, glad you asked. I put durable goods new orders on a year-over-year basis against 10-year treasury yields, and you can see there's a very nice relationship between the two. When durable goods new orders start to go up, it's kind of inflationary, and yields go up. And when they go down, yields go down. And so yields are in a downtrend. There is a bit of a blip here, but that is likely transitory. They're not perfectly joined at the hip, but look at the direction of new orders. They are headed lower. And is there any likeliness that you see in any of the data so far that's showing reflation for new orders? No. See, everyone's hooked on this, trade deal. Look, even if the trade deal was all passed and all the tariffs were dropped tomorrow, does that mean people are running out and spending? We don't see it. I don't know people that say, well, I'm putting off that new home sale. I haven't heard businesses say, well, you do see some in the business data, but obviously they're buying their stock back. So obviously they're not too concerned about how the trade war is going, because if they were concerned, they'd bankroll some of that money for when times get better and they need cash. But instead, they're just putting money back into their stock. So we see no signs of reflation here at all. All right, well, I guess that's done with that. So let's go and look at some charts, see what we can find here. S&P 500 is within barely a stone's throw of its all-time high. It is rocketing up there based on emotion, but we do see, we could use that, but you see an open gap here is waiting, and let's see, that gap was closed. So there's an open gap there that needs to be filled. This is unlikely to hold. If we were looking at the futures market, you would see there are gaps riddled through here that need to be filled and taken care of. They haven't. The Treasury market, on the other hand, has filled all of their gaps, even the most micro gaps on the way up, but they've left all kinds of them on the way down. So today, you see, here's a gap, and there's two gaps right here. So again, all of these things do get filled at some point, but we see, is there a big problem with Treasury yields? No, they're sitting near their 100-day moving average. There's, again, no evidence of reflation in the data. Every time yields go up, the data gets worse. So what will happen is this is a consolidation. How do we know that? Well, we can go and look at TLT, and you can see there's some stopping volume here. Now, what has happened after the market put a stop to it, it started to consolidate, and it starts to go sideways. It'll go blip up and down, and you can see a little consolidation phase right in here. And how do you know that? Because what happens is volume cools off, and the big players sit back and try to let the sellers exhaust themselves. And you see right there here, volume dropped, sellers exhausted themselves. You can almost say this was a long consolidation pattern. What happened when consolidation ended? Boom, the buying commenced. And we know there is a gap sitting right here, here, and up here. Now, it doesn't imply that tomorrow they get magically filled. What it tells us is when we look at the other data, is the risk that interest rates are rising and bond prices are going to fall? No. It just means speculators and other market participants are taking the bond market and using it to buy stocks, which we can clearly see right here. Because earnings, we're having an earnings recession. They're down like 3/4 now. Profits are lower than they were 5 years ago, and they've been steadily declining again. So everyone's focused on, but earnings they're beating analyst estimates. Oh, so you mean to tell me earnings are beating the analysts who sell you stocks that have watered down their estimates to super low levels, so you will go and buy more stocks? Those analysts? Yeah, those are the ones. So when you look at this, again, there's no sign of reflation. The market wants reflation because people are tied up in stocks and they don't own a lot of bonds. So here we see still the risk in 10 years would have to be a weekly close over 1.9 before we really started to get worried, but yields really didn't budge all week. They just kind of went down and back up. But the direction, again, there's gaps all the way down below here that need to be filled. Even crude oil came up to oil and gas producers got up to their 50-day moving average. No sign there of anything reflationary. I mean, does this look reflationary? I'll show you. Reflationary is a move like this starts to look, these bigger moves are more reflationary than that. So there's no big signs of reflation in the crude oil market, especially if we look at crude oil itself. You see, it went up a little bit to 56, but that's not massively reflationary at all. And we look at the 30-year zeros, tagged their 100-day moving average. Nice big volume in here, slowing this down. So there are people that are coming in here and buying this stuff, which is great. That's what you want. What's surprising is that short-term interest rates are down because the Fed is essentially suppressing short-term interest rates. But next week, they got at least a 25 basis point cut, maybe even 50. Would not surprise me at 50. At some point, the market panics because they're just completely discounting the overnight repo stuff. They're acting like it's not a big deal. You look at junior gold miners. Still, I know everyone's, they're breaking out today. Still looks like a topping pattern. The market is still flushing this out. There's still a lot of speculators that are long gold. Ag commodities, not pricing in any of the harvest news. It's not going to be until the USD says there's a problem. But what's nice is they're just consolidating along here. Consolidations are part of the bigger trend, which means we have an uptrend. 50-day moving averages rise. Wait. You say, wait a minute, this is a downtrend. No, it's a long, here's the whole consolidation range in treasury bonds is here. The trend is still up. This isn't over because you get a blow-off move when you have speculators who are still short bonds. As far as trading volume goes on, the S&P 500 still very weak. On a week, this is terrible. Oops, let's go to it's 20 a week. I mean, you're down here. One of the worst weekly volume going back to 2006. Not a lot of trading action going on there at all. So, long story short, not a lot of reflation. There's no signs of reflation, no sign that interest rates go higher. There's just been a mountain of data the last 2 weeks, just more and more data saying no, interest rates are too high. As we know, the data is correct. Just a matter of the market figuring it out. So we hold position, let the markets do what they need to do. Again, when you're looking to make somewhere between a 30, 40, or 50% return, you got to set up some drawdown. You just have to. Believe me, I wish my timing was better. It's not perfect. No one's is. But again, we know where this is headed because we still have 16 months of monetary lags to get through. And as of early next week, probably the week after next, the 10-year treasury yields will be leading the stock market lower by 13 months. Record on books is 14 months. Crazy. I'm Steve Van Metre. I'll be back with you Monday. We'll take a look at hedge fund positioning, and hopefully the bond market will start to turn around. But and if not, I'm sure it will soon because we've got the Fed cutting. And when the Fed cuts, short-term rates go down. So do long-term. Have a great weekend. Bye now.